Welcome to the Deep Dive. Today we're zeroing in on a true giant in the global food and beverage arena, the Kraft Heinz Company.
Absolutely. Huge name. They wrapped up 2024 with net sales around $26 billion.
And their mission? Quite simply, let's make life delicious.
Right. And for this deep dive, we're really aiming to dissect that 2024 performance. We'll be using their 2024 Form 10K as our main source.
So we'll be digging into their business segments, the key financials, and importantly, how they plan to create value for their shareholders.
Exactly. We'll cover the key trends, their growth strategies, specific initiatives they're undertaking, and, the challenges they face.
Think of it as getting the crucial insights without needing to read the entire 10K yourself. Okay, let's unpack this. How does a company this, massive, actually organize itself?
It's interesting. They use what they call modular and configurable platforms, basically ways to group related products like condiments or cheese.
Modular and configurable.
Yeah, and the role these platforms play can actually change depending on the specific market or segment. They categorize these roles as accelerate, protect, and balance.
Accelerate, protect, balance. Sounds quite strategic. Can you break those down a bit? What does each one mean for them?
Sure. So accelerate platforms are the ones they see having the highest long-term growth potential.
Okay.
These usually have better gross margins and a bigger market share. Think of these as their growth engines, where they're really pushing innovation and expansion.
So high growth areas, likely newer products or categories they're trying to dominate?
That seems right. They don't list exact brands per platform in the 10K, probably for competitive reasons, but yeah, that's the idea. Innovation, tapping into new trends.
Makes sense. And protect. What's the story there?
Protect platforms have more moderate growth potential, but they're still important high gross margins, significant market share.
So established leaders.
Exactly. These are often their big, well-known brands. They need consistent investment to, protect that strong position, defend the turf, so to speak.
The reliable cash cows they need to maintain. Okay, and the last one, balance.
Balanced platforms are often more commodity-heavy categories. Think things with relatively flat growth potential.
So not huge growth drivers.
Not really. Their main job is just maintaining the brand's overall footprint, keeping those everyday staples on the shelf, contributing steady revenue.
Got it. So a mix of growth, defense, and just keeping things steady. Now, how do they get all this stuff, the ketchup, the cheese, to us?
They use a pretty wide distribution network. Their own sales teams deal with the big grocery chains, but they also use independent brokers and distributors.
From multiple channels.
Oh, yeah. They reach grocery stores, convenience stores, online platforms, plus food service distributors who supply restaurants, hospitals, you name it. It's a broad reach.
Sounds complex to manage. Now, food is fast-moving. Innovation must be key. How do they approach that?
Definitely focus. They talk about investing in new products, extending existing lines, keeping things fresh.
But that's risky, right?
It is, and they acknowledge that in the 10K. You never know for sure if a new product will click with shoppers and retailers. Plus, they stress protecting their intellectual property patents, trademarks, that sort of thing.
Super important. Okay, let's shift from products to people. What's their approach to human capital?
They frame it around their purpose, dream, values, and leadership principles. The goal is attracting, developing, and keeping good people.
How many people are we talking about?
As of the end of 2024, around 36,000 employees globally.
Wow.
Yeah. And they mention their total rewards, philosophy, compensation, benefits, wellness, aiming for an engaged workforce.
36,000. That's a city. Okay, companies also adjust their focus through buying and selling parts of the business.
Yeah.
How does Kraft Heinz use M&A?
They definitely use acquisitions and divestitures strategically. The 10K notes a couple of sales in early 2024, their infant nutrition business in Russia, and a subsidiary in Papua New Guinea.
Shedding some non-core assets, maybe?
Seems likely. They also sold a B2B powdered cheese business back in 2022. It's about focusing the portfolio. But they also point out the risks, integration challenges, financial complexities, operational hurdles.
Always a balancing act.
Yeah.
Now, running a global company like this must come with a lot of risks. What do they highlight?
They lay out quite a few. There's the challenge of actually getting the expected benefits from those strategic deals, integrating acquisitions smoothly.
And being global means?
It means dealing with different foreign laws, currency swings, tariffs, trade policies. It's a complex world out there.
For sure. Anything else stand out on the risk front?
Well, Berkshire Hathaway's ownership stake is significant, about 27.2%. That gives them considerable influence over management and the board.
Right, that's a big chunk.
They also mention their substantial debt load, which could constrain their flexibility, and of course the volatility of commodity prices, raw materials, energy. That's always a big one for food companies.
Did they see much inflation impact in 2024?
They said they experienced moderate inflation in supply chain costs, and they actually expect that to continue into 2025.
Okay, so cost pressures remain. What else?
Regulatory risk. The food industry is highly regulated. Cybersecurity is another big one they mention. They've appointed a chief information security officer, have a program in place.
Any major breaches reported?
Thankfully, no. They state no material incidents as of the report date. They also flag risks from economic and political instability, potential business disruptions like natural disasters affecting the supply chain.
A lot to keep an eye on.
And finally, they mention restructuring. They cut about 270 positions in 2024 to streamline things and expect to cut around 740 more in 2025.
So efficiency moves alongside everything else.
Yeah.
Okay, seems like they're juggling quite a bit. Let's turn to the financials. What were the big headlines for 2024?
All right, looking at the consolidated results, net sales landed around $25.8 billion.
This is down a bit.
Yeah, down from $26.6 billion in 2023 and $26.5 billion in 2022. They note the unfavorable impact from those divestitures we mentioned. It's also useful to look at their organic net sales figure, which strips out those impacts and currency changes for a clearer underlying trend.
Got it. So the sales dip was partly due to selling off businesses. How did the different regions perform?
North America is still the powerhouse, $19.5 billion in net sales, $5.1 billion in adjusted operating income for 2024.
Still the biggest piece by far.
Definitely. International developed markets brought in $3.5 billion in sales and $537 million in adjusted operating income, and emerging markets added $2.8 billion in sales and $321 million in adjusted operating income.
How did that compare to the year before?
Well, comparing to 2023 shows the mix of factors at play: pricing actions, changes in volume and product mix, those supply chain costs we talked about, and foreign exchange rates hitting each region differently.
Right, lots of moving parts. Let's dig into the key income statement numbers for 2024. What really jumps out?
The big one is operating income. It swung from a $4.6 billion income in 2023 to a $1.7 billion loss in 2024.
A loss. Wow, what drove that?
Primarily huge impairment losses. They took a $3.7 billion non-cash charge.
$3.7 billion. On what?
It relates to reducing the value of goodwill and intangible assets, specifically mentioning brands like Lunchables, Claussen, Waddy's, and some reporting units. It suggests they've reassessed the future earning potential of those assets.
That's a massive write-down.
Ouch.
How did other parts of the income statement look?
Interest expense was pretty steady, $912 million, same as 2023. Other expense income flipped to an $85 million expense, partly due to losses on those divestitures and currency issues in high inflation countries.
So putting it all together.
It meant income before tax was actually a loss of $856 million compared to that $3.6 billion income in 2023.
And the bottom line, net income.
A net loss of $837 million for 2024. Quite a turnaround from the $2.8 billion income the year before.
Which translates to?
Diluted loss per share of 7.70 cents versus earnings per share of $2.31 in 2023. They do also report an adjusted EPS number, stripping out things like that impairment charge to give a different view.
A tough year, profitability-wise, dominated by those write-downs. Okay, what about financial health? Liquidity, cash flow.
Their cash flow from operations was strong in 2023, $4.0 billion. The 2024 number isn't explicitly broken out here in the same way, but looking at other cash flows.
What about investing?
They used about $1.0 billion for investing activities in 2024. That includes payments for the TGI Friday license and higher capital expenditures, offset somewhat by investment hedge settlements.
And they expect similar spending going forward.
Yeah, they're projecting about $1.0 billion in capital expenditures for 2025, too. So continued investment in the business.
And financing activities. Where did cash go there?
They used $3.0 billion in financing activities in 2024. The big driver was increased share repurchases, buying back their own stock. That was partly offset because they didn't repay as much debt as the year before.
And they have access to funds if needed.
It seems so. They highlight their $4.0 billion credit facility, now extended out to 2029. And interestingly, they haven't had any short-term commercial paper outstanding at year-end for the last 3 years.
Okay, so despite the loss, they're managing capital, investing, and returning cash via buybacks. Let's focus on that shareholder value piece. What are the main ways they plan to deliver value?
Well, cash dividends are one direct way, though the specifics are in another part of the report. The other big one is that share repurchase program.
Right, the buybacks. Tell us more about that.
Sure. The board approved a $3.0 billion program back in late 2023, running through the end of 2026.
How much is left?
As of the end of 2024, they still had about $1.9 billion authorized. And they were active in Q4 2024. The report details buying back over 14 million shares.
So actively reducing the share count.
Exactly, which can help boost earnings per share over time. They also mentioned some open market debt repurchases back in 2022, but no activity on that front reported for 2024 here.
So dividends and buybacks are the main tools right now. Okay, wrapping things up, looking ahead, what's the overall assessment based on this 10K?
Well, it paints a picture of a company navigating some significant challenges, but also looking for opportunities. Managing that ongoing cost inflation, dealing with the complex global environment, executing their strategies, staying innovative, those are all crucial.
And things like accounting for high inflation in certain markets.
Right, that continues to impact their reported results in places like Turkey, Argentina, Nigeria. Cost management and efficiency are clearly ongoing priorities, too.
Any other forward-looking hints?
They're keeping an eye on the changing international tax landscape, like the OECD's plans. And as we mentioned, they expect moderate supply chain inflation to persist in 2025 and plan to spend about $1 billion on CapEx, signaling continued investment.
So managing costs while still investing for the future.
Seems to be the plan, you know? Those big impairment charges in 2024 really signal a hard look at some assets. How well they manage the whole brand portfolio, especially driving growth in those accelerate areas, will be really key to watch.
It's definitely a balancing act. Cost control, investment, returning cash to shareholders.
Precisely.
Well, this has been a fascinating deep dive into Kraft Heinz's 2024. We've covered their structure, the financials, the risks, the strategies for shareholder value, all straight from their 10K. It really highlights just how complex running a global food giant is.
It absolutely does. You see all the interconnected pieces, consumer trends, supply chains, global economics, big financial decisions, all shaping their path forward.
Definitely. And maybe a final thought for you, our listeners, to consider. Given that significant $3.7 billion impairment hit in 2024, what kind of bold strategic shifts might Kraft Heinz need to make to really drive future growth and get profitability back on a stronger track?
Or how might they need to adjust the balance, the investment and focus between those accelerate, protect, and balance platforms as consumer tastes and the market keep changing?
Something to think about. Thanks for joining us for this deep dive.